we're in a bubble. And, people, and starting with central bankers, but a lot of analysts say, well, you can't identify a bubble till after it bursts. And when it bursts, you go in and clean up the mess. But the idea of smoothing bubbles or dealing with bubbles in advance is misguided, because you can't really know that they're bubbles, and there might be good reasons for it. But you can kind of clean up the mess after it bursts. That's completely wrong. But there's nothing easier to spot than a bubble. I mean, all you have to do is, look at a chart of the Nikkei index in 1989. Look at a chart of the NASDAQ in 1999. Look at the chart in the collateralized mortgage obligations in 2007, or the stock market today, I would argue. You can spot bubbles a mile away. What's hard is knowing when they're going to pop. And it's the case that markets can be irrational, and they can be in bubble territory far longer than you expect. So I don't recommend going out and shorting a stock index. You're in a bubble. Say, oh, why don't I go short the stock index or buy a put option and make a lot of money? You could lose a lot of money. You can lose money being right when you say it's a bubble, but that doesn't mean it's going to burst at your convenience or on your timing. So it is a bubble, but it'll break when it breaks. But what happened in early April 8th in particular, was more a reflection of the first thing I just said, which was that it's a bubble condition, and B, there are plenty of reasons to believe we're in a recession or close to a recession. That's a whole other analysis. But again, the tariff news might have been a bit of a catalyst, but it's not the main cause. The main cause is the market wake up and say, we're way out. You use the expression over your skis. I'm a skier, so I know exactly what you mean. But the idea that we're in bubble territory, we're vulnerable, it wouldn't take much to pop it. That's all correct. I think what happened in early April was a reflection of that. You can blame the tariffs, but there's something much more fundamental going on.
They keep telling you this rally is real, but according to this analyst, it's not just fake, it's dangerously rigged. Just 7 tech stocks now control nearly 40% of the entire S&P 500, creating the illusion of a healthy market while the rest of the economy quietly crumbles. He says we're in a full-blown bubble that you can see coming, just like the Nikkei in 89, the NASDAQ in 99, and subprime in 2007. April's sudden drop wasn't random. It was the first tremor. And this bubble isn't driven by fundamentals. It's being held up by low rates, AI hype, and Wall Street's fear of missing out. Now the Fed has paused again. The recession signals are flashing, and retail is being lured in for one last round before the floor gives way. This is no longer a bull run. It's a trap. And according to this warning, you've got less than 72 hours to get ahead of what could be Wall Street's most brutal implosion since 2008.
Well, I would say it is the entire stock market. I'm not saying there's not one good company. There are many, and even in crashes, even in the Great Depression. By the way, the best performing stock on the New York Stock Exchange during the Great Depression between 1929 and the kind of mid to late 30s was Homestake Mining. It was a mining company. It was a gold company. Well, what happened to gold in the Great Depression? It went up 75%. At the beginning, it was $20 an ounce, and by the end, it was $35 an ounce. So gold went up 75%, measured in dollars, during the Great Depression. Homestake Mining did very well. So there are always opportunities, and I'm not suggesting otherwise. But getting back to your question, this is the S&P 500 is kind of it's not a joke, it's a misnomer. Let me explain why. There are 500 stocks in the S&P 500, but there's 7 of them are close to 40% of the entire market cap. The S&P 500 is what's called a cap-weighted index, meaning you don't just add up all the prices and divide them by 500 and come up with an average price. If your company has a larger market capitalization, it becomes a larger part of the index, and its behavior affects the index as a whole. So we've got 7 companies, and we know who they are. It's Apple, Microsoft, Meta, which used to be Facebook, Alphabet, which used to be Google. I mentioned Amazon, Netflix, Tesla, a couple others. The list names kind of add on. Nvidia, but there are literally 6 or 7 companies that are close to 40% of the entire market cap. So of the S&P 500. Now, of course, an even larger percentage of the NASDAQ composite index. So this bubble, which comes not exclusively, but mainly out of the tech stocks, mainly out of having to do with artificial intelligence. That's the narrative of the year, so to speak, is driving the S&P 500 and the Nasdaq well into bubble territory, and then some of them are in the Dow Jones. So Dow Jones is a little bit less important these days, but so the short answer is it's affecting all the major indices. When they crash, they're all going to crash together. We got a taste of it in early April. I agree with that, but then, so what happens when that happens and the market goes down? It was, believe a bear market. It technically in all three indices down 20%. One of them might have been, I think the Dow might have been down like 19.5%, but close enough to 20. But they were all at 20% or below. Nasdaq was a little bit below that. What happened? Well, all of a sudden, here comes the Wall Street narrative: buy the dips. Fear of missing out. It'll come back. And oh, by the way, the tariff thing's over. But that goes back to my earlier point, Alex, which was this bubble preceded Trump's election. It preceded any discussion of trade wars and tariffs. The trade wars and tariffs are not over, by the way. They'll be back, but we can talk about that. But so it was a little bit of a catalyst, like a reason to go down, but it wasn't. It didn't cause the bubble, and it's not going to cure the bubble in and of itself. So those stocks went down pretty quickly. What drove the bubble? A couple things. I mean, going back even further, low interest rates. Now, the Fed between March 22 and June 2023 did raise interest rates significantly, and that put a little bit of a headwind on the stock market. But then, beginning in I believe it was July 2023, they hit the pause button. They stopped increasing rates. Then you had over a year, and then it was in September 2024 that the Fed started to cut rates. They cut them a few more times in November and December, the November and December meetings, and then they stopped again. So we're on pause. The Fed's not raising rates anymore. So that gave the stock market a little boost, took it out of its funk. The tariff thing was a setback. Now it's come back because people assume that the tariff situation has resolved itself. But none of what I just described gets to the heart of the issue, which are these recession economics that we're seeing, and it hasn't hit with full force yet, but it has in some ways, and let me be clear about that. A recession has a rule of thumb definition. It's 2 consecutive quarters of declining GDP. Now, there's actually more to it than that. There's something called the National Bureau of Economic Research up in Cambridge. They decide when the recession begins, the recession ends. They're pretty much worthless from an investor's point of view. And the reason I say that is because they take so long to announce when the recession began that it's usually over by the time they announce it. So if a recession began the first quarter, and maybe it did, maybe it didn't, but let's see. But they won't even address that until like early 2026. And it may be over by then. So you can't rely on them as any kind of guide. You have to do your own analysis and draw your own conclusions. But there's something bigger than a recession, which is a depression. And people assume, they say, well, if a recession is 2 consecutive quarters, 2 or more consecutive quarters of declining GDP, and a depression sounds a lot worse, so that must be 10 quarters of declining GDP. But that's actually not the definition of a depression. And I used John Maynard Keynes' definition. I think it was good enough for him. He said a depression is a sustained period of below trend growth with neither a tendency to get back to trend nor to collapse entirely. In other words, it's depressed growth. So you can have growth during a depression, but the growth is depressed relative to potential, and that's lost wealth. So right now, for a mature economy like the U.S., I mean, the only way the U.S. could grow, 5.5% would be if we're coming out of a recession. You have some unused capacity for at least a short period of time. You can grow above trend. Now, long-term trend, U.S. 3.25%, 3.5%, that would be pretty good, steady growth. But we've been growing at 2, or 2.25% at the most. From 2009, right after the global financial crisis, until the end of 2019, just before COVID, and COVID was a special case. But for that 10-year period, average annual growth, real GDP was 2.2%. So there was growth. It was not, there was no technical recession in that period. But if your potential is 3.25, 3.5, and you're growing at 2.2, you're leaving trillions of dollars, at this point upwards of $10 trillion of lost wealth on the table. That's wealth you could have created, an income you could have created that you didn't because you were in a depression. So my view, the US economy has been in what I would call a long depression since 2007. And we're still in it. It doesn't matter actually if it's Trump or Biden or Obama for that matter. We're not getting back to those trend numbers that I talked about earlier. Could we have and will we have technical recessions in the middle of that? Yes, they'll happen, and we should be looking out for one right now. But the bigger issue is a failure or inability of the U.S. economy to get back to trend or anything close to it, and just what I would call a long depression.
So here's the bottom line. What looks like a record-breaking rally is actually a carefully disguised bubble inflated by just a handful of tech giants and propped up by media spin and easy money. The warning signs are all flashing: April's shakeup, the Fed's pause, recession-level fundamentals, and a market far detached from reality. If you're still chasing momentum, understand this isn't a boom. It's the calm before the collapse. Now that you know the truth behind this fake rally, you're going to need to know what's coming next, because the next video on this channel reveals the next major financial trigger Wall Street hopes you'll miss. Don't get caught off guard.